Over the last century, the stock market has consistently transformed modest savings into significant wealth through the power of compound interest. Yet, despite this massive upward trajectory, most retail investors manage to consistently lose money. For decades, economists explained this away using the rational actor model. This theory assumes that human beings make decisions by weighing utility and risk like cold, logical calculating machines. Under expected utility theory, a framework championed by mathematician John von Neumann, investors supposedly evaluate absolute probabilities without a single drop of emotion. But there is a glaring flaw in that assumption. Human beings are not intuitive statisticians. We are biological organisms, and our brains are hardwired first and foremost for survival. Treating the stock market like a purely mathematical puzzle fails because it ignores the physical realities of human biology. That realization earned behavioral psychologists Amos Tversky and Daniel Kahneman a Nobel Prize. They proved that classical economics was missing the human element. They mapped a framework showing the brain operates on two distinct tracks. The first is System 1, our fast, emotional survival drive. Running parallel is System 2, the slow, analytical center. Engaging System 2 requires intense effort, so our brains use it sparingly. The modern stock market is a hyper-competitive environment perfectly designed to trigger and exploit those fast System 1 instincts. If you do not understand how your own biological hardwiring is being manipulated by the noise of the market, your portfolio will be destroyed by your own reactions. When System 1 reacts to the market, it relies on the availability heuristic. This is a mental shortcut where the brain judges the probability of an event based on how easily recent dramatic examples come to mind. This shortcut leads directly to performance chasing and FOMO, the fear of missing out. Investors see others profiting from a sudden rally, impulsively buying late. Social pressure often overrides personal analysis. This herding bias drives retail investors to pile into crowded, overvalued trades simply because everyone else is doing it. Buying based on FOMO replaces strategic analysis with pure urgency. It ensures that retail investors enter the market precisely when the risk of a crash is at its peak. Once you own a stock, the holding period begins. Here, System 1 actively works to protect your ego by utilizing confirmation bias, the tendency to seek out information that supports your choices while ignoring contradictory evidence. This is compounded by anchoring bias. This is the psychological tendency to fixate on a specific reference point, like a stock's past high price, rather than evaluating its current fundamental reality. These biases create the conditions for a value trap. Investors will buy shares of a declining company under the false assumption that a lower price automatically equals a bargain. System 1 prefers a simple, comforting narrative of a triumphant comeback. That desire blinds the investor to deteriorating business fundamentals, turning a supposed bargain into a total loss. The scientific core of behavioral finance is prospect theory. It proves humans evaluate financial outcomes as asymmetric gains and losses relative to their current situation, rather than absolute wealth. This graph shows the prospect theory value function, illustrating the core mechanism of loss aversion. The psychological pain of losing money is twice as intense as an equivalent gain. Notice the curve is much steeper for losses. This proves human reactions to wealth are reference-dependent. This extreme sensitivity leads to myopic loss aversion. This is the destructive behavioral habit of hyper-focusing on short-term market dips and weighing them far more heavily than long-term trends. This creates a contradiction in market behavior. Investors often panic sell at the absolute bottom to stop the immediate emotional pain, yet simultaneously hold on to bankrupt stocks just to avoid admitting defeat. System 1's desperate instinctual attempt to avoid immediate emotional pain is the exact mechanism that systematically destroys wealth. The hard truth of behavioral economics is that we cannot rewire millions of years of evolutionary biology. System 1 will always be running in the background. Successful investors build external frameworks that force System 2 logic to take the wheel before a crisis ever hits. You can achieve this through time separation and predefined criteria. Setting strict rules like stop-loss orders before entering a trade removes the emotional burden of choice during a market crash. The most effective countermeasure to myopic loss aversion is goals-based investing, a strategy where portfolio decisions are driven by specific life objectives rather than market benchmarks. This chart shows how mental accounting can be utilized positively. By tying specific assets to tangible lifetime goals rather than daily ticker fluctuations, you reframe the risk and ignore the noise. The financial industry is designed to feed and exploit your primal instincts. Building wealth over a lifetime requires a structural system that outsmarts your own biological hardwiring.